So in this video, what I'd like to look at is the key factors considered when setting interest rates by a central bank. This is one of the most important things that a central bank does, such as the Bank of England, the Federal Reserve, the European Central Bank. They need to set an interest rate that will hopefully achieve their inflation target. And this is within 2 years' time. Why 2 years' time? Because it takes up to 2 years for a change in interest rate to have its full effect on the economy, both on the demand side and on the supply side. So to achieve the inflation target, which is often set for most central banks by the government, for instance, with the Bank of England, its target is currently 2% CPI, and it can be 1% below that or up to 1% above that. It tries to hit the target in the middle at 2% in 2 years' time, and that's its guiding principle in terms of setting interest rates. Inflationary pressures are what the bank considers, and a central bank will often have several hundred, well, 100 or more people, very bright people, working on this. There's a lot of brain power that goes into this. The Bank of England has 9 people that meet regularly on the Monetary Policy Committee that sets the interest rate in order to achieve the inflation target. So they look at lots and lots and lots of key data, both on the demand side and on the supply side, to work out whether there's going to be cost push inflation or demand pull inflation, or indeed whether there's going to be a growth in the money supply that might be inflationary. So let's look at some of the key factors that they'd consider. First of all is really GDP growth. Is the growth rate of the economy above the trend rate of growth, which, if it were, is potentially inflationary on the demand side. Too much demand relative to supply, and you could end up with demand pull inflation. So GDP growth is a particularly important measure. How much spare capacity is there in the economy, or is there none? So do we have an output gap that's positive or an output gap that's negative? That is absolutely crucial. And economists, of course, don't always agree on exactly what the output gap is. It's estimated. So this makes it even more tricky. And so part of this, you might look at what's happening to the level of consumption in the economy. What's happening to the level of saving? Is the saving ratio going up or is it coming down? Is the marginal propensity to consume increasing or decreasing? What's happening to the level of investment? And of course, what's the government doing with fiscal policy? And of course, what's happening to exports compared to imports, net exports? We could look at that as well. So when you're looking at this, you might think about what's happening to the productivity in the economy. If the productivity is looking good, then you have more room for economic growth, and vice versa. On the second area, you might look at bank lending and the amount of consumer credit. How much are people borrowing on their credit cards, which will result in consumption and could result in demand pull inflation? What's happening to bank lending from high street banks? And a third area you might look at, of course, which is important, is house prices and share values, because if these go up steeply, it could lead to a positive net wealth effect. People feel more confident and therefore they spend more in the economy. Sorry about the bell. And then a fourth area, so that's positive net wealth effect we look at there. A fourth area we might look at, which is a particularly interesting indicator, is consumer confidence and business confidence. So if consumer confidence is very buoyant and business confidence, it means there's likely to be an increase in consumption in the future, and there's likely to be an increase in investment in the future. And so this could be inflationary. So these are often known as leading indicators, and they indicate perhaps if it's a turning point in the economy. They're based on survey evidence, and A lot of this information is in the past, the very recent past, but the past nevertheless. Whereas this is actually forward-looking, because it's sort of based on people's psychology, how they're feeling about the future. And the Bank of England placed so much store on this, you might say, consumer confidence, business confidence. They actually have agents, a job I'd quite like, where you go around chatting to as many businesses as possible to get a feeling of to what extent the economy is buoyant, what is business confidence like in different parts of the country. And these feed through via the agents into the Monetary Policy Committee. Of course, they also do use of survey evidence for business confidence and consumer confidence. And so fifthly, a really important area is wage inflation. Because if wages are rising too fast, they may cause cost push inflation. So for example, imagine you had productivity growth of 1% and wage growth at 2%. No, let's go for 3%. Wage growth of 3%, would you be bothered? If you're trying to get to an inflation target of say 2%? Well, the answer is you can pay people 3% more as long as the productivity is going up 1%, because the productivity will make up for 1% of your wage increases. So take 1 from 3, you've got 2, it's probably not too problematic. So knowing that the rate at which productivity is going up is rather important. So a key part of this is looking at unit labour costs. How much in terms of labour does it cost to make a unit of output? And if this is increasing significantly, there's the danger of inflation. And therefore you might want to increase interest rates to stave off the future inflation. Another area often not always looked at by students is the exchange rate. Because obviously if the exchange rate, say, depreciates, it might have an inflationary effect both on the demand side and the supply side. Look at videos on the exchange rate to explain that, and of course vice versa. So the exchange rate can be volatile, and it's certainly something that the Bank of England or any other central bank would consider. If you've got a fixed exchange rate, at least that makes that more straightforward. And then we come to number 7. You need to also look at international economies. So the big economies in the world, like what's happening in China, USA, Japan, the Eurozone, Britain, et al. France, that's part of the Eurozone, of course. So you need to consider what is happening to growth, what is happening to inflation in those countries, because that will affect your exports. And finally, commodity prices, particularly oil, but also foods and other basic primary commodities such as metals. These prices could obviously feed through into cost push inflation, so they're well worth considering. So within 2 years there's bound to be some sort of shocks to the economy, both supply side or demand side shocks, both from within the economy and outside the economy. So it's a tricky job looking ahead 2 years. So it's hardly a perfect science setting the interest rate in the economy. Okay, I hope that was useful. Thank you very much for watching.